Welcome to Geared for Growth. I'm your host, Mike Mortlock, Managing Director of MCG Quantity Surveyors. Now, what are the property investment fundamentals that you should never sidestep? We're answering that very question today with an industry guru, Miriam Sandkuhler. She is the CEO of Property Mavens and the author of a best-selling book. And this talk we have today is based on a lot of the stuff that's featured inside that book. The fundamentals that help you get the first investment property right and the subsequent ones on the back of that as well. We talk about understanding risk profile and, of course, the risk profile of the least risky participant in that investment. A lot of people are buying with a husband or wife or partner or friend or family member or colleague. We talk about getting the experts to help you purchase that investment property and get that right, minimize the risk and maximize the results, and also considering who you're getting advice from and where their fiduciary interest comes into play. Are they a family member? Do they have a vested interest? It's an awesome interview with Miriam, and I really hope you enjoy this one. Here's Miriam. Miriam Sandkuhler, thanks for joining me on Geared for Growth.
Mike, lovely to be here. Thank you so much.
I've been looking forward to this one for a while. Obviously, you've been in the game for a long time, and there's a lot of wisdom that we want to extract from between your ears. So we're talking today about the property investment fundamentals you must never sidestep. And I think this is something great for property investors that are looking at beginning or ones that are wanting to build their portfolio. So I'm happy to have you today.
Oh, thank you so much. So if I can just briefly introduce myself, I'm the CEO of Property Mavens. We are a multi-award-winning industry recognised advocacy firm. We do buyer and vendor advocacy. I'm also a best-selling author and REIV Buyer's Agent of the Year, as well as a few other credentials. But as you said, I'm here to talk to people about investment fundamentals you must never sidestep. So I guess some considerations people really need to take into account when they're investing is, have they created a property strategy? Have they done a risk profile? Have they considered the type of property they're looking at? Have they considered any new legislation that's applicable within the state that they're looking to buy, particularly around minimum standards? And then things like cultural appeal as well. So I'm going to talk today about the 7 things very briefly that you need to think about. One of them is, people often mistake free advice and they think it's good advice. And what I mean by that is the property industry isn't regulated by ASIC. There is no legal requirement to be a qualified property investment advisor of any sort. It's very much buyer beware, because we know that selling agents and project marketers and property spruikers always offer free advice, but it's biased and it's designed to sell a specific property or project they're trying to get rid of. They're not acting in your interests and they don't care whether it ends up being a good investment or not, versus, say, engaging someone who's a licensed buyer agent, where they are unbiased, that you'll pay them an advice-based fee, they work for you and they legally represent your interests. So that's the one thing for the consumers to really understand, that free advice is not free. There is a cost associated with it, but you won't know that cost until it's too late. And usually it's often negative capital growth, no capital growth, opportunity costs, or basically their whole portfolio development fails because they've got one chance to get the first one right. And if they get it wrong, that's the end of their investing opportunity.
And I guess the cost can also be sort of considered in that, rather than paying a buyer's agent fee, you're paying them a fee that they're getting through the developer, right? So in a way you are paying for it, but you're not the one shelling it out. So their sort of fiduciary interest is not to you as the person they're giving advice, right?
Yeah, well, the fee's built into their commission. They get either what we call a marketing fee or a sales commission. The cost of the property is increased to cover the cost of that fee. So consumers are actually paying for it. It's just hidden in the purchase price. So that's one way that it's presented. Then there are organisations out there who pretend to be buyer agents, but they only introduce you to off-the-plan properties. So there's a conflict of interest there. There's a whole lot of confusion around that. And I'll talk a little bit later about some articles and some blogs I've written about fake buyer agents and, what happens if you're coming up against someone who's charging really cheap prices. What does that mean in terms of the quality of the service you're going to get?
Yep.
The other thing I say to people as well is you're going to pay a price whether you engage an investment qualified advocate or not. And that's usually through a mistake that you're going to make. And when you don't know what you don't know, that's where the mistake will show up, and it'll show up in years to come and you won't understand what's happened. So people will pay one way or the other. They just don't know it. The other thing I want to talk about is people understanding their risk profile. And, certainly in financial planning, if you work with a financial planner, they always talk about risk. And that's the extent to which someone will expose themselves to a potential loss in order to make a certain level of gain. But most people don't factor their risk profile in when it comes to buying property. And so generally, you need to understand if your risk profile is low, moderate, high, or very high. And you need to understand your risk appetite, whether it's low, moderate, high. And if you're a single versus a couple, that's a whole nother load of complication. Because if you're in a relationship where you don't have risk profiles that correlate, I can guarantee you there'll be fights and stress and all sorts of things going on about money. So it's really important you get that clear to start with. Generally, my advice is invest according to the persons with the lowest risk profile so they can sleep at night. And then the risk associated with property is totally dependent on the type of property, the zoning, if it's residential, if it's commercial, if it's industrial, if it's short stay. So just understand that some of those have got much higher risks and limited resale opportunities than others. And one size does not fit all, which is where getting some expertise and some help comes in. The next thing is having a plan. Failing to plan is basically planning to fail. So a lot of investors go, we'll buy a property, but they don't have a realistic goal. They don't know what they want that property to do. They don't reverse engineer the outcome and factor in their age. They don't necessarily know their strategy, whether it's capital growth, cash flow, or a balance. And they might know their entry strategy, but they may not have a clear hold and exit strategy as well. So that's definitely something that needs to be taken into consideration. The other thing that people do is they skimp on engaging the right experts. It's so disheartening to see people buy properties where they don't get a contract review done before they buy it and they don't get a building and pest inspection report done. There have been many times where I've looked at a property as an option for a client. We've walked away because of building issues and quite significant ones or contractual issues. And someone buys the property and it's usually someone naive who's done none of that reporting, but they don't realise they've just bought themselves a $50,000 problem. So again, experts need to come in at the right time to help you maximise return and minimise risk. And that's the equivalent of dealing with a mortgage broker when you're getting a loan, having a meeting with your accountant, your financial planner to make sure that your structure is right before you apply for the loan. And then obviously dealing with someone who's an accredited property investment advisor or an investment qualified buyer agent. And then at the stage where you're signing a contract, before you do that, you want a solicitor or a conveyancer to review it for you to make sure you're aware of any issues that are significant, particularly in things like apartments with cladding issues, owners' corporation fees. There's so much complexity and there are so many issues in recent years that have come up regarding poor quality in terms of buildings that you want to know about, that sort of thing. Yeah. And then, when you're looking at buying a property, you want to get a building and a pest inspector out. And I know it can cost money, and I know when people miss out several times, they're quite heartbroken, but you have to understand it's an insurance policy to prevent you making a $600,000, $800,000, million, $2 million mistake. So it's insignificant in the scheme of things. If you got one chance to get it right, it's it's a way of minimising that risk. And then, of course, once you've bought the property, you do not want to self-manage. The legislation is so complex. I mean, I know in my portfolio, I wouldn't even consider managing any of my properties myself because I don't have the time to keep up with the legislation, let alone manage all the minimum standards that have to be implemented in investment properties nowadays. So absolutely bring on board your property manager, bring on board your insurance broker. Your insurance broker is going to organise, you can get valuations on the property for insurance purposes and obviously getting the quantity surveying done to maximise, your deductions that are available to you, which, of course, Mike, is where you come in.
Yeah. Thanks for the plug there. We also look after the insurance replacement cost estimate as well. And I'm glad you brought that up, because that is a critical area where people are exposing themselves to risk. And most property investors, I don't think necessarily utilize the services of an insurance broker. They go sort of straight to the company, an NRMA or an AMI or something like that. I definitely recommend talking to an insurance broker.
Yeah, same, because they've got access to multiple companies. They're familiar with policies, because anyone can buy a cheap insurance policy,
Yep.
but it'll all turn to muck when it comes to claiming, and you find out that you're not covered for ABC because you didn't understand what you were buying in the first place. And obviously, frequently I'll have a client come back to me and go, well, I'm talking to the insurer and they want to know what the land value is and the property value is and the replacement value is. And it's like, well, I'm not qualified to do that. Here's the expert that can do it. And the reason you need to do it, and this is where most people don't understand, if someone underinsures their property and they make a claim, the insurance company isn't going to give them the amount they've insured for. They're going to give them the percentage of the amount that they've been underinsured for. So if they're 50% underinsured, then they're only going to get 50% of the 50% they've insured themselves for.
Yeah.
So, it's incredibly complex and it's unbelievably high risk. And again, this is where experts come in and the importance of protecting yourself in that instance.
Absolutely.
Then I suppose the next thing to really take into consideration is research. Most people don't understand macro and microeconomic indicators when it comes to buying property. They don't factor in population growth, supply, employment opportunity, infrastructure development on a macro level, and which is what's going to stimulate a particular market. And then on a micro level, it's local amenity, home buyer demand versus investor demand versus tenant demand. Now, this will vary from state to state, from city to city, from region to region. But you do have to deep dive into that to know whether or not you're buying in the right area. And don't just look at one growth driver. People go, well, I'm going to buy in Melton because, 5 million people have moved there in the last few years, which is great. But population growth alone isn't a reason to invest, particularly if you're buying in areas where there have been lots of recent land subdivisions. You've had significant amount of people moving into the area. But sometimes what happens with that is councils are unprepared and they don't have enough amenities. So they're short on room in the local schools to accommodate all the families and kids that have moved into the area. There's no job opportunities. Public transport might not be sufficient. So, relying on one growth driver is risky. Understanding multiple growth drivers is important. And then understanding the difference between a regional city versus a metro city and the needs of the locals in that area will differ significantly from the needs of someone who's in a metro location. Then we want to understand supply and demand. So people who are often, say, just focusing on population growth alone, as I said, hotspotting, that's where they get a little bit stuck. People who invest for tax benefits as the main focus and a tax deduction rather than for the principle of capital growth, cash flow, or a balance of the two. That's the biggest mistake. Accountants are all very strong at saying, hey, go buy a property, get some tax deductions. But the last thing you want to do is buy a crappy brand new or off the plan property that's going to depreciate but get zero capital growth because it's badly located. And you'll get a tax deduction for a certain period of time. But then when you get no growth or negative growth, it's a very expensive exercise to receive a few tax benefits. You're best focusing on, what's your strategy, capital growth, cash flow, balance of the two, and then deciding what to buy. And tax benefits are a benefit of investing, but they should never be the reason to invest.
It's funny you mentioned that. I did a video on that just this morning titled Tax Depreciation is a Bonus, Not a Strategy, and I talked about the best property to buy for depreciation deductions, and it was essentially, a high-rise unit in a massive complex, and it begs the question, well, is that a good investment? And I think history would say, no, it's a terrible investment, but it's going to be great for deductions. The deductions will be fantastic, but the strata fees will keep you up nights, right? The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Yeah. And the other thing too, all those property spruikers who give you free advice, because quite frankly, they're shit assets and they're a shit investment. And I say that deliberately so people wake up to what I'm saying. They can only ever flog these properties by banging on about the tax deductions, because that's the only positive thing they can offer. And they use to convince people to buy them. And they've got all this data and research, which all sounds fantastic. But at the end of the day, one of the fundamentals you need to consider is buying for land value, not land size. And if you're buying one apartment in a building of 100 and you own 1/100th of the value of the land that building sits on, well, then you've got a pretty bad investment, because you've got, hey, a whole lot of depreciation, but the property's going to go down in value, which means your investment will go down in value. And you've got almost zero land value, so you're going to get zero and negative potentially capital growth. So this is where people make the mistakes of, listening to these property spruikers and buying new, buying off the plan, buying apartments, buying high rises, and they consequently pay a really expensive price.
Exactly.
And the other thing, does it have the right combination of factors to hold its value during a downturn? I know when we assess a property, we want to buy what's called an A-grade property. We look at 57 attributes and we analyse that property to determine if it ticks the boxes, and if it does, great, we buy it. And if it doesn't, so be it. And the difference between a property, say, that's an A-grade property, someone who buys a C-grade property or an underperforming can either get very little capital growth, no capital growth, or negative capital growth. And if someone, say, for example, invested $1 million and they only average 3% capital growth per annum, in 10 years it's worth 1.3 million, in 20 years it's worth 1.8, and in 30 years it's worth 2.4 million. And you might think you've made money, but the stuff that we buy, being A grade, we want it, and generally they return between 8 to 11% capital growth per annum. So just working on $1 million at 8% per annum, in 10 years it's worth 2.1 million, in 20 years it's worth 4.6 million, and in 30 years, it's worth $10 million. So property selection is everything. If you do not buy that right property at the very beginning and ensure it's a high-performing property, you have the capacity to lose tens of thousands, hundreds of thousands, millions of dollars in capital growth over the longer term just by making that bad decision. And that's what I mean about, if people want to go it alone and they don't know what they don't know, that's where they'll pay the price down the track unknowingly. Then we look at something around not understanding the rules of negotiation. I mean, I know some people think they're fantastic negotiators and they might be in their job, but real estate's very different. Every agency and every agent has different policies around auctions. Every auctioneer will call an auction differently. Most people don't understand price quoting, and there's a lot of underquoting that still goes on. They don't know how or what influences come into the buying process. They may not understand auction terminology. They may not have a bidding strategy in place. There's no prize for coming second, and you certainly do not want to put yourself in an emotional situation where you'll be easily manipulated, because people do not make good property buying decisions when they're emotional.
Absolutely.
And then lastly, I'd say, you want to review your portfolio. A lot of people think that it's a set and forget opportunity, but markets change rapidly. There are supply and demand factors, employment opportunities, infrastructure changes, population growth. These can work for you, but they can also work against you. So falling in love with a property makes it harder to sell if the market turns bad. You really need to treat it as a business, and holding onto a poor performing property without any evidence to support the decision in the false hope that things will improve can cost investors thousands of dollars in lost equity or capital growth. And I've had situations where I've advised clients to sell a property and they've had a $20,000 loss after holding it for 3 years. And because they couldn't bear the thought of making a loss, they actually did nothing about it. And by the time the bank forced them to sell 3 years later, the loss went from a $20,000 loss to a $60,000 loss. So look, we're all human. We all make mistakes. But if you sometimes take that loss and get the right professional advice, you should be able to recover that loss in the short term, and then blue sky will step in. But, certainly I made my mistakes. I've written about them in my their selling book, Property Prosperity. I've talked about lots of client case studies and the mistakes that they've made, including the underinsurance and all the rest of it. So, yeah, they're the things that you need to do.
That's a really interesting. Sorry, Miriam. I just wanted to highlight that point about the loss. Loss aversion is a really strong thing, right? And you see it probably a lot in people that are starting small businesses. There's a high failure rate, and things can turn around in the negative very, very quickly. And there's a lot connected to that. I mean, that could be your hopes and dreams, and I think that's similar with the property. But sometimes it is the best decision to get out because it's a sinking ship, right?
Yeah, and people, what comes in is pride, what comes in is shame, what comes in is ego, and one of the reasons I love working with clients is because I help them take the emotion out of a decision. And, you can see we've got a screenshot here of an example of getting it wrong. And I said to my clients, they really struggled, and they didn't buy this with my help by any means. But when I said to them, look, you really need to sell because there are 2,000 more apartments coming into the suburb in the next few years, and it's only going to get worse. And lo and behold, they didn't want to hear that. They struggled to lease the property. And as I said, a few years later, when the bank forced the sale, they ended up with actually a $70,000 cash loss by the time you factor in costs and all the rest of it. But then they had this idea that, well, maybe we can, get the kids to buy it from us. I'm like, but hang on, it's an asset that's declining in value. It's a bad asset. Why would you want to lumber your children with it? Yeah. Some people aren't capable of hearing that they've made a mistake. And you can't help everyone. But if they're willing to, bite the bullet and then take steps to, recover their borrowing capacity, buy a better performing asset, wait till, the loss breaks even and then they're in blue sky, you can actually recover. So long as you don't hold on to a situation where you've invested a lot of time or money in the hope that, it'll get better one day when you've got no evidence to support that. Yeah. Make evidence-based decisions, not emotional decisions.
We'll share a link to the slides here in the show notes as well. But just having a look at that picture, you could imagine that could be very attractively marketed, right? It's got an interesting facade. St Kilda East is quite a nice area. That'd be a spruiker's dream, right? The gloss on that brochure would almost sting the retinas. So it's an easy trap for people to fall into. But as you say, there's so much density that went into that area. Being losing $60,000 over 5 years, you think about the opportunity costs. I mean, your slide was kind of saying 8% at $1 million. We're talking $1 million of growth over 10 years. So that could be $500K. Split it in half even because the purchase price was a bit lower than this one. They could have made $300,000 or $400,000 over that period.
Oh, easily, absolutely. And then we've got situations where particularly people who are buying off the plan, and this happens a lot with the Asian community where they're foreign investors and they get spooked too. This is a gentleman who actually bought 3 apartments in 2020. The first one he bought for $1.56 million. We reviewed it recently and we indicated that one was now worth $1.2 to $1.3 million. Now, this is a very, very wealthy person. They just bought a commercial office block in Sydney, so they've got money. But when we also showed him that the 2 penthouse apartments he bought in Sydney had also dropped $400,000 each. So all up, he was over $1 million in capital loss because he bought off the plan apartments where you pay a developer a premium. There's very little land value, and then everything that we expect to happen has happened. Again, same thing. He can't bring himself to sell them and take the loss, even though he can carry it, because pride is there, and he can't bring himself to take any action because that would be an admission of failure. So it's really sad. But you know what? You can get it right by buying the right property with the right attributes that, make it a high-performing A-grade property. It's possible to get significant growth. And when you get the first one right, like I'm showing you on this slide, we had a client, Theo, where he had 33% capital growth in 25 months. We leveraged into his next property. We bought $30,000 under market value and he had 24% capital growth on that. And so at the end of the day, when you get the first one right and you get your equity growth correct, you can leverage into your second one. When you get those 2 right, you can leverage into your third one. Unfortunately, we have clients who come back for their second, third, fourth and fifth property because by getting that first one right, it allows growth. But by getting that first one wrong, you shot yourself in the foot and you've helped, most people can't carry those losses and they can't recover from them, which is just really sad.
Yeah, and we talked a little bit about that off air. The average property investor, I think it's 68% now. It was 72. 68% of property investors only ever own one property. Now, that's great if that's your goal, but I'd hazard a guess that most people, their goal is to really change what their financial future is, and there's a fairly strong argument that one property is not going to be enough. So it begs the question, why aren't the average investor getting 2, 3, 4 properties? And I think it's because they don't get the first one right and they don't understand the fundamentals, which makes this a really timely episode of the show.
Yeah, no, they don't. They don't. And therein lies my point before. People are going to pay whether they engage a professional or not. It's just, do they pay in the form of no capital growth or equity loss, and that's the end of their portfolio, or they pay an expert that can get them an outcome, and then they come back again and again and again because they're actually ahead of the game making money.
Mm. And isn't that interesting that the people that are doing a good job, they're really building their business based on their reputation, whereas, that's doesn't strike me as the same thing for people that are selling properties off the plan. It's just get it done and find somebody new.
Yeah, so there's no accountability, and I was going to share 3 tips with you, which I'm happy to do now.
Yes.
Talking to that. So number 1, understand your risk profile so you know the type of property you're buying. And as I said, people don't make good decisions when they're emotional. They're subject to manipulation and the games agents play. They overpay, they have buyer's remorse, they buy over their limit, they get carried away at auction. And, we're all human. There's no shame in getting help. If you understand this is one of the biggest investments you'll ever make, by trying to do it yourself with no expertise and no understanding of the complexity around it, you may as well take your money and go to the casino because it's a gamble, no different.
Yeah.
Chuck your money on a table and good luck. But by engaging the right experts at the right time for risk mitigation, that's where you minimise risk, maximise return. One thing I will say is be careful. There are fake buyer agents out there and a lot of cheap buyer agents out there because they don't know what they're doing, and the only way they can get businesses to offer a cheap price. But again, you'll pay the price. I've got some blogs on my website around that. But one thing I'll say is, for the fee that you pay a buyer's agent, which is not dissimilar to, say, what you pay a selling agent when they sell the property, it's much cheaper to engage a buyer agent than make a $600,000, $800,000 mistake. And the other thing is be very careful who you seek advice from. Are they accountable if they give you bad advice? So a selling agent, a lot of them make claims on investments that is illegal. They should never be actually saying this is a good investment because of X, Y, Z. They do it. They've been getting away with it. Property spruikers do it. They've been getting away with it. But once they've sold, they dust their hands of you. They walk on and they move on, and they have no regard or interest whether it's a success or not. They've made their money. They run. Same as family and friends. Everyone has an opinion, but if they give you their opinion and it turns to crap, are they going to reimburse you the money that you've lost as a result of taking their advice?
Certainly not. I wouldn't have thought so.
No. And there are family relationships that are split up. There are friendships that are split up. So my attitude is if you're going to invest hundreds of thousands or millions of dollars, take your advice from an expert where there's accountability. They've got qualifications, a reputation, a brand that they stake on their expertise. Because I can tell you now, if you listen to mum and dad who's done it twice, or some friend who's got a different risk profile and they're taking a totally different strategy that's not appropriate for you and your risk strategy, and you go down that path and you lose money, they're not going to be compensating you.
Absolutely.
So I guess that's sort of it in a nutshell in terms of the things that the investment fundamentals you must never sidestep. And look, certainly from our point of view, if anyone wants to go to the website, propertymavens.com.au, we offer free consultations. I've got a number of blogs there, particularly one around there's always someone who'll do it cheaper and the consequence of cheap advice, as well as the rise of fake buyer agents in the marketplace and what consumers need to know. I'm also, I don't know if you've got any listeners who are experienced advocates or real estate agents who are wanting to transition, but I'm the only business in Australia whose franchised advocacy is a business model, and we're recruiting nationally. So if you've got any listeners who are already working in the industry and they have experience, not for newbies and wannabes, but they're experienced real estate agents and they're experienced advocates, feel free to reach out. And as I said, there's plenty of resources on the website that they can download for free.
There you go. I think those tips are fantastic. I mean, understanding the risk, I got a real takeaway when you're talking about the couples, because that's not something we talk about much on the show. And most people will be investing with a partner or a family member, so you've got to kind of understand that risk. The team of experts is just a crucial thing, and I think there's always going to be people that are going to be able to do it cheaper, but often in life, that old adage, you get what you pay for, it is true. So it's important to create that team and not invest based on what sort of Uncle Barry thinks is the next hot spot at the barbecue. It's a real pleasure. Thanks for sharing your wisdom today, Miriam, and we'll have you again back soon, hopefully.
Thank you, Mark. It's been lovely to be here.
Cheers.
Bye.